This strategy lost $700 in backtesting. Today, it's making $12,000. I didn't change the entry signal. I didn't add a fancy indicator. I fixed one thing that 90% of traders ignore: how we exit. This is part 3 of the Triple EMA series, and we're not guessing anymore. We're engineering. In part 2, we proved that raw backtest profits are an illusion. Add real pot firm costs, commissions, spread, and slippage, and a $20,000 edge vanished into a $700 loss. So we stopped optimizing blindly. We built a testing framework. Isolate one variable, test the raw edge, apply costs. Only then do we judge if it survives. This is the scientific method applied to trading. You change one parameter at a time so you know exactly what caused the shift. We ran 5 independent optimizations. Let's walk through the data. First, risk-reward. We increased it from 1 to 2 to 1 to 3. Hypothesis: bigger winners should absorb fees better. Result: it didn't. Raw profit dropped because fewer trades hit the wider target. With costs applied, we still lost over $1,200. Here's why. A 1 to 3 ratio requires a much higher win rate threshold to remain profitable after fees. When you widen your target, your trades sit in the market longer. They get exposed to more volatility, more reversal risk, and more time decay. The math showed us that higher reward alone doesn't fix a cost-bleeding system. Second, the trend filter. We added a 200 EMA rule. Only buy above it, only sell below it. Hypothesis: filtering noise trades reduces fee bleed. Result: it worked, but barely. Trades dropped by 10%. Costs dropped. Net profit flipped to plus $482. Profit factor hit exactly 1.00. It survived, but it's fragile. $400 over 2 years isn't an edge, it's a warning sign. The 200 EMA is just a slow-moving average that defines macro trend. It successfully filtered out choppy ranging periods, but it also kept us out of some profitable mean reversion moves. The edge was real, but too thin to scale. Third, wider stop loss. We moved from a rigid 1% stop to 1.5%. Hypothesis: Bitcoin's volatility chokes tight stops. Give it room, reduce false exits. Result: this was a breakthrough. Trade count dropped by 53%. Fees plummeted by 69%. Net profit jumped to plus $2,773. Profit factor 1.05. Reducing frequency mattered more than filtering direction. Every single trade cost money. By widening the stop, we reduced the number of times we paid the spread and commission. We stopped getting shaken out by normal intraday noise. The strategy started breeding. Fourth, lower time frame. We tested the exact same logic on 15-minute candles. Hypothesis: faster data means more opportunities. Reality: it failed. Win rate collapsed to 30%. Profit factor dropped to 0.79. Net loss $1,420. The edge doesn't scale down. More signals just meant more friction. Lower timeframes increase the noise to signal ratio. Market microstructure dominates. Spread and slippage eat a larger percentage of each move. The EMA crossovers whip around constantly. What works on the hourly chart drowns in noise on the 15-minute. Fifth, ATR-based dynamic stops. This is where the strategy transformed. Instead of guessing a fixed percentage, we let market volatility dictate the stop distance. We calculated the 14-period average true range. True range measures the most extreme price movement of a single candle, comparing current high-low range against yesterday's close. We averaged those values over 14 periods. Stop-loss distance became ATR times 2. Take profit stayed at a 1 to 2 reward ratio. But here's the professional layer. Position sizing adjusted automatically. Position size equals 1% of capital divided by the ATR stop distance. High volatility, wider stop, smaller size. Low volatility, tighter stop, larger size. You always risk exactly 1%. No arbitrary numbers, just math. This decouples market noise from your risk exposure. Result: trade count dropped by 46%. Fees cut in half. Win rate jumped to 39.9%. Profit factor hit 1.20. Net profit plus $12,008. ATR didn't just improve the strategy, it made it cost-proof. Look at the final comparison. Baseline, negative 745. ATR version, positive 12,000. Only 2 tests turned a profit after costs. Wider stops helped. ATR dominated. For those new to quant testing, 3 terms matter here. Look ahead bias, using future data to make past decisions. We eliminated it by shifting signals to the next candle open, ensuring we only trade on confirmed closes. Profit factor, gross profit divided by gross loss. Anything above 1.0 survives. Below it, you bleed. Position sizing, the math that keeps risk constant. We never risked more than 1%, regardless of stock width. These aren't buzzwords. They're the firewall between a backtest that lies and one that tells the truth. Now, the hard question, is this result trustworthy? Can we trust $12,000 in a simulation? The answer is not yet. A backtest is a hypothesis, not a proof. We could be curve fitting to 2 years of specific Bitcoin volatility regimes. In the next phase, we stress test it. Walk forward analysis, where we train on past data and validate on future rolling windows. Monte Carlo simulation, where we shuffle trade sequences to test if our equity curve survives bad luck streaks. We'll see if this edge holds when the market changes, or if it only worked in this specific window. But I'm not doing this alone. I want your optimization ideas. What filter should we test next? Volatility targeting? Machine learning signal confirmation? Session-based filters? Volume profile confirmation? Drop your idea in the comments. Even if it sounds crazy, we'll test it in a dedicated video. Because in quantitative trading, the best edges often start as unconventional ideas. And once we validate the robustness, part 4 is where we turn this Python script into a live trading bot. Which platform do we use? MT5? CTrader? Custom API? We'll bridge the gap between backtest and execution, handle live data feeds, and deploy with real risk controls. If you want the complete Python code for this ATR engine, it's linked below. Subscribe for the stress testing phase. Trade systematic. Verify everything. I'll see you in part 4.